On the 15th of September 2008, the impossible happened. Lehman Brothers, one of the oldest and most powerful investment banks on Wall Street, filed for bankruptcy. More than 25,000 employees woke up uncertain whether they still had jobs. Investors around the world watched in disbelief as a company managing over $600 billion in assets simply collapsed. Within hours, stock markets plunged. Credit markets froze. Businesses couldn't borrow money. Families lost their homes. Retirement accounts shrank overnight. The world had entered the worst financial crisis since the Great Depression. But Lehman Brothers didn't fail because of one bad investment or one unlucky day. Its collapse was the result of years of reckless decisions, unchecked greed, and a dangerous belief that the housing market could never fall. This is the story of how one of America's most respected financial institutions became the symbol of global financial disaster. Lehman Brothers wasn't originally a bank at all. The company began in 1850 when three brothers, Henry Emanuel and Mayer Lehman, immigrated from Germany to Alabama. They opened a small general store serving local farmers. Instead of taking only cash, they accepted cotton as payment. As cotton prices soared, the brothers realized there was more money in trading commodities than selling groceries. That simple decision transformed their business. After the Civil War, the company moved to New York and became deeply involved in the growing American financial markets. Over the next century, Lehman Brothers helped finance railroads, airlines, retail companies, and industrial giants. It survived the Civil War. It survived 2 world wars. It survived the Great Depression. For more than 150 years, Lehman Brothers adapted to every crisis. But the one challenge it couldn't survive was its own ambition. By the early 2000s, America's housing market was booming. Home prices seemed to rise every year. Banks competed aggressively to approve mortgages, and borrowing money became easier than ever. Even people with poor credit histories could qualify for loans. These were called subprime mortgages. Traditionally, banks would keep mortgages on their own books, meaning they carried the risk if borrowers failed to repay. But Wall Street had developed a new system. Instead of holding mortgages, banks bundled thousands of them together into securities known as mortgage-backed securities, or MBS. These securities were then sold to investors around the world. Investment banks earned enormous fees by packaging and selling them. The more mortgages they created, the more money they made. It became a machine that rewarded quantity over quality. Lehman Brothers jumped into the business with incredible enthusiasm. The bank bought mortgage lenders, expanded its real estate division, and accumulated billions of dollars in mortgage-related assets. As long as housing prices kept rising, everything looked perfect. But there was a hidden problem. Many of these mortgages were issued to borrowers who could barely afford them. Some had no proof of income. Others made little or no down payment. Many loans offered extremely low introductory interest rates that would later increase dramatically. The assumption was simple. If homeowners couldn't make payments, they could just sell the house at a higher price. That logic worked until housing prices stopped rising. When prices flattened and then began to fall, millions of homeowners suddenly owed more than their homes were worth. Defaults increased rapidly. The mortgage securities that Wall Street believed were safe started losing value. No one knew exactly how much these complex financial products were actually worth. And that uncertainty spread fear throughout the financial system. Lehman Brothers had another major problem. It was heavily leveraged. Leverage means borrowing money to make even larger investments. Used carefully, leverage can increase profits. Used recklessly, it magnifies losses. Before the crisis, Lehman reportedly operated with leverage exceeding 30-to-1. That meant for every dollar of its own capital, it controlled more than $30 in assets. As long as asset prices increased, profits looked spectacular. But when those assets lost value even slightly, the losses became enormous. It was like balancing a skyscraper on a very narrow foundation. One strong shake could bring the whole structure down, and that shake was coming. By 2007, cracks in the housing market had become impossible to ignore. Mortgage defaults surged, investment funds failed, banks began reporting massive losses, confidence disappeared. Yet Lehman Brothers continued assuring investors that everything was under control. Executives believed the market would recover. Instead of reducing risk, they doubled down. The bank continued holding billions of dollars in increasingly worthless real estate assets. As confidence faded, investors began selling Lehman's stock. Credit rating agencies considered downgrades. Business partners became nervous. The warning signs were everywhere, but meaningful action came too late. During the summer of 2008, the situation became desperate. Lehman tried to raise new capital. It searched for buyers. Potential rescue deals involving major financial institutions were discussed. Several possibilities emerged, but none ultimately succeeded. Without fresh funding, the bank faced a growing liquidity crisis. On the weekend of the 13th of September and 14 government officials, regulators, and banking executives gathered in New York to find a solution. Many expected the U.S. government to organize another rescue, similar to earlier interventions. Instead, something very different happened. This time, no bailout came. On the 15th of September 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. It was the largest bankruptcy filing in American history. At the time, more than $600 billion in assets were caught in the collapse. Financial markets were stunned. The effects were immediate. Stock markets around the world plunged. Money market funds suffered unexpected losses. Banks stopped trusting one another. Lending nearly froze. Companies that depended on short-term financing suddenly couldn't access cash. Businesses delayed hiring. Consumers cut spending. Panic spread across the global financial system. The crisis quickly expanded beyond Wall Street. Factories reduced production. International trade slowed. Millions of workers eventually lost their jobs. Families struggled with mortgage payments. Foreclosures increased dramatically. Entire neighborhoods were left with abandoned homes. What began as a banking crisis became a worldwide economic recession. One question has been debated ever since. Why did the U.S. government rescue some financial institutions, but not Lehman Brothers? There is still disagreement among economists, policymakers, and historians. Some argue officials believe there was no legal authority to save Lehman without adequate collateral. Others believe they wanted to send a message that not every failing institution would be rescued. Some think they simply underestimated how devastating the consequences would be. Whatever the reason, the decision became one of the most controversial moments of the financial crisis. In the days after Lehman's collapse, the government reversed course and provided extraordinary support to other major financial institutions to prevent an even larger collapse. Many observers believe that Lehman's bankruptcy demonstrated just how interconnected the global financial system had become. The financial crisis permanently changed banking. Governments introduced stricter regulations. Banks were required to hold more capital. Stress tests became routine. Risk management received far greater attention. In the United States, reforms such as the Dodd-Frank aimed to reduce the chances of another systemic financial collapse. While debate continues over whether these reforms go far enough, few dispute that the events of 2008 reshaped modern finance. Lehman Brothers, however, never returned. Its offices emptied. Its employees scattered across the financial industry. Its name became synonymous with failure. Today, the former Lehman headquarters still stands in New York, but the company itself exists only in history books and financial case studies. Its collapse wasn't simply the story of one bank making bad decisions. It exposed the dangers of excessive leverage, weak risk management, opaque financial products, and the belief that markets could rise forever. More importantly, it revealed how deeply connected the global economy had become. When one institution failed, the consequences spread across continents within days. The collapse of Lehman Brothers wasn't just the end of a 158-year-old investment bank. It was the moment the world realized that even the biggest names on Wall Street could fall, and when they did, the cost would be paid by millions of ordinary people who had never set foot inside an investment bank.